Hi, everybody, and welcome to TMC Connect. Today we have Paul Chiarelli. He's with ACS. He's a CPA and a partner with ACS, and they've been a member of the Mortgage Collaborative for many years, and we appreciate their partnership. There have been some changes and some proposed changes for the regulatory changes for financial requirements. And Paul wanted to talk with us today about those changes and what the ramifications of those changes will be to TMC. So I'm going to turn it over to Paul, but just want to let you guys know that this was set up as a meeting. So please feel free to go with your video on if you'd like. You can also unmute yourself at any time and ask Paul questions as he goes through his presentation. We will be sending out a follow-up email tomorrow with a link to this recording, as well as connection for the deck that Paul will be reviewing. So without further ado, Paul, I am going to turn it over to you.
Hey, everyone. It's nice to see everybody, or, through Zoom in this world now. But, I'll get right to it. I'll talk about the first thing we're definitely going to touch on today is the changes regarding Fannie, Freddie, and Ginnie. I'm sure that you probably have already heard through some channel or another that there have been changes. They were proposed a year ago, and it looks like that they received all their comments, and these look like they're going to be final, even though they're still comment periods. It doesn't look like they're going to change, but we'll talk about those. Secondly is leases, which, if you remember from 5 years ago, a lot of the accounting conferences have, I want to say, beat it to death because it was supposed to be implemented in 2020, and given COVID and given everything, they've pushed it back to this year. And it's certainly going to be a major change to your balance sheet and to how you record or account for these leases. Then I want to touch on material events. I know HUD has been sending out auto-generated emails regarding notifications of material events. We'll talk about what's supposed to be reported. We will then also, if we have time, we'll talk about a refresher in the changes on unacceptable assets, which went into place last year, along with being able to monitor your debt covenants appropriately and getting ahead of the curve. And in an environment like this, sometimes it's better to tackle these before you start the audit rather than after. So first we'll start and we will talk about Ginnie Mae's changes. And as you could see, for all the Ginnie Mae issuers, you're familiar with the existing requirements. Certain changes, I think initially we expected the changes to be a lot harsher, but it looks like that everything has eased up a little. But Ginnie Mae certainly has concerns, and which was the purpose for their change. So first, calculation of net worth really hasn't changed. Normal GAAP equity, less your goodwill and tangible assets, affiliated receivables, net deferred tax assets, valuation adjustments on certain assets. And usually I tell my clients to also consider HUD's in Chapter 7 handbook, consider their unacceptable assets as well. The existing requirement to the net worth is your base of 2.5 million plus 35 basis points of your single family UBP on Ginnie Mae securities, along with your available commitment authority. This is now changed. I'll go in my last slide. We'll talk about the effective dates of these, but the proposed requirement that they've just came out with is base requirement is still staying at 2.5 million plus 35 basis points of Ginnie Mae security UBP along with the commitment authority, plus an additional 25 basis points on your Fannie and Freddie servicing UBP, and plus additional 25 basis points on all other servicing UBP. So as you could see, it looks like they have now added Fannie and Freddie's UBP to this as well, which could be a significant impact to this calculation. If you are a smaller Ginnie issuer and you are primarily Fannie Freddie servicing portfolio, this will now impact your Ginnie requirement. Second is the base liquidity requirement. just like just similar, liquidity is calculated using cash and cash equivalents. Larger issuers probably have AAA rated government securities, agency MBSs, obligations of GSEs. Something that I've noticed this year is your principal and interest, taxes and insurance, and foreclosure advances are also now are included in your liquidity for Ginnie Mae. That is something to consider, where obviously given the current environment, especially 2020 with forbearances, this 2021 still effective. And even today, a lot of my Ginnie issuers are still telling me this. So those advances now count towards your liquidity. Your existing requirement was the greater of $1 million or 10 basis points of your Ginnie Mae UBP. The proposed requirement keeps the base of 1 million plus your 10 basis points of Ginnie Mae servicing. Plus on additional, I'll go to the bottom first, is 3.5 basis points on all other servicing. And then it tiers your Fannie Freddie servicing. If you have scheduled to scheduled, it's 7 basis points of that UBP. Scheduled to actual, 7 basis points, and actual to actual, which I would primarily assume most people are using with Fannie, is 3.5 basis points. So now this is added to your liquidity requirement as opposed to just Ginnie Mae. This has been a bigger conversation for my smaller Ginnie Mae issuers, where their portfolio is primarily 80% Fannie Freddie. Now bringing Fannie Freddie UBP into these calculations obviously causes a significant increase in Ginnie Mae's requirements. Okay, they have a new liquidity requirement in general. This doesn't apply for smaller issuers. This only applies if you are originating more than $1 billion in mortgages in the last 4 quarters consecutively. So if you're looking at year end, it would be for that year. The proposed requirement is you would have to maintain liquidity of 50 basis points of your outstanding loans held for sale and interest rate lock limit. This is new. This is not something that has been around. There has been concern for this, certainly, if you're a Ginnie issuer and you don't securitize a lot. But obviously, it's something to keep in note. This does not go into effect in 2022. So it's not an immediate cause for concern, but it is something to look out for next year. Okay. Finally, we talk about leverage ratios, and leverage ratios stayed the same. 6% was always the same for Ginnie. That remained unchanged. In the original proposal, they wanted 9%, and they switched it to 6%, which was a good, which is good for Ginnie issuers. This is new. This is new to IMBs. This is something called risk-based capital requirements. This is more, or has been for years, with depositories. They've always had risk-based capital requirements, whether it was with the FDIC, and even Ginnie instituted a risk-based capital requirement for depository institutions. If you're familiar with the Chapter 6 HUD guide and you looked at the examples of the calculation in the back, there was always one for depositories and one for non-depositories. You'll see that this was always a requirement for depositories. It's still at 6%, but this is how it's calculated. The way that they're doing is they're weighing the assets on your balance sheet, and that is now your new denominator in your calculation. It's the usual ratio, right, that they've used is net worth over your assets has to be at least 6%. Well, now they have something called risk-weighted assets, and to the right, I put together, or I snipped this from the Ginnie Mae proposal that they originally did in 2021 on how to calculate this. I also have an Excel template that I will share with the TMC to email it to everybody on what you can, as a template you can use for yourself. But, with the big thing here, which is a concern, is that they're weighing MSRs at 250%, not to exceed your adjusted net worth. So if you look at the example, it doesn't, I don't picture this being, if your assets aren't primarily made up of MSRs, this may not be a significant impact to you. But if it is, it could cause a large impact because they're weighing MSRs so large, at 250%. So as you can see in the calculation, that's how they would calculate it. The new addition here is your risk-based capital ratio, the net, it's not just your adjusted net worth, it's minus your excess MSRs. If you're not familiar with excess MSRs, that has always been a tax term, a tax terminology. I don't want to get into the intricacies of your excess MSRs now, but this is something to look out for. And my contact information will be shared at the end of this, and you could certainly reach out to me directly if you would like to speak more regarding it and how that's factored into this calculation. But this is certainly new to independent mortgage lenders. Okay, now we're going to switch our gears over here and talk about the changes for Fannie and Freddie. The purpose of the changes, especially, we've noticed that the FHFA and Ginnie Mae have worked hand in hand. Both of them have came out with on their websites PDFs of each one of their proposals, and you can tell that they try to align a lot of their requirements together. So there are certain things that are only included in Ginnie, not Fannie and Freddie, and vice versa. But as we go through this, you'll see the base is pretty much aligned on a lot of these requirements. For example, the adjusted net worth calculation, the existing requirement, 2.5 basis points plus, or 2.5 million plus 25 basis points. Proposed requirement, very similar to Ginnie Mae, 35 basis points of Ginnie Mae, 25 basis points of Fannie, Freddie, and all other servicing. Okay, liquidity requirements, base liquidity requirements. You can see the calculation of liquidity slightly differs here. You have trading securities and unrestricted cash and cash equivalents, but the FHFA allows you to take into consideration 50% of your unused portion of the servicing advanced line of credit, which is a good addition. If you have a line of credit on servicing it, or if you have that facility, you can count it towards your liquidity. The existing requirement, 3.5 basis points, but they used to factor in 200 basis points on non-performing agency servicing in excess of 6% of your total servicing. The proposed requirement is right in line with what Ginnie is requiring. 10 basis points of Ginnie, and then you're tiered on your Fannie Freddie portfolio, and then ultimately 3.5 basis points on everything else. So the big difference here is the calculation of the liquidity, and Fannie and Freddie will include your unused 50% of the unused portion of your servicing advanced line of credit. Next, origination liquidity requirements. Again, lockstep with Ginnie Mae on this, 50 basis points of loans held for sale on IRLC in its simple form. The new requirement, this applies to larger non-depository lenders. Maybe a lot of you will not fall into that category today, but you would have to have a liquidity buffer, 2.5 basis points of your of Fannie Freddie and 5 basis points of Ginnie Mae. Capital ratio has remained the same, 6%. That stayed the same for Ginnie and for Fannie. There was no changes there. So going to the effective dates of this, as you can see, this is a good chart to follow. The first effective date is not until 9/30 of 2023. So there is some time to adjust for this and plan appropriately for this. This came right from Ginnie Mae's handout that they published. Again, I will share that with you as well, so you can kind of use that as a base. That's where most of my information has came from today in regards to these changes. Secondly, which moving forward, is I really wanted to spend at least 5 minutes here, a little longer, to talk about leases. I'm sure your auditor has probably already reached out to you. You may have already received emails from them, or somebody would have had to communicate with you by now. This is a big change. The new requirement says that under GAAP, all leases have to be recorded on the balance sheet. You would have something called a right of use asset or a lease asset, and you would have an offset liability there, which would be the present value of your future obligations on these leases. It's a big change. What's the biggest change other than putting an asset and your liability on your books? Ideally, The net impact to equity should not be material. We don't know that until you do the calculation because everybody will be different. But your leverage ratio will change. You will be adding a liability while equity will be staying the same. Certainly have these conversations with people, with your vendors that look at this requirement. I'm sure they have already thought about this. Public issuers, so UWM, Loan Depot, they had to adopt this when they went public. Public issuers had to adopt it in general in 2020, I think 2019 maybe. So I'm sure that warehouse lenders are aware of this, and it's a conversation that you should be having with them because you will have a large liability on the books. I don't want to go into the intricacy of the calculation, but I wanted to highlight some key points here. First is you take the full lease obligation, you present value it. The biggest component of that is an assumed interest rate. A lot of my clients ask, what interest rate do I use? I'll tell you, ACS will be okay with the borrowing rate at the time you enter into the lease. Obviously, you should have an internal memo drafted. You should have reasoning and justification on why you're using that implied interest rate or why you're using that interest rate in the present value calculation. So in very simple terms, if you have a lease that goes for the next 5 years and it's $1 million of total lease payments, if you present value that, it'll be lower. It may turn out to be $750,000 of a liability. Well, what does that mean? Your rent payment's not changing. You have interest expense now on your leases. You will be a portion of your rent payment every month will not the whole in past, your whole rent payment would go to rent expense, or if you straight lined your rent, it would have a different impact, but you never had an interest component to this. Now, every month you should be recording a lease interest expense on your P&L. The thing, jumping to number 5 real quick, this is effective as of 1/1/2022. So this is not a end of the year audit entry. This is something that should be being evaluated internally now, maybe in Q3, because you will have an adjustment in not only to the balance sheet, but I'm sure if you haven't adopted this as of 1/1, you've probably been applying your total rent payment to rent expense. There will obviously be a strip there that will have to go to interest. So it is an entry that should be evaluated now. Reach out to your auditors, reach out to your accounting firm. If it's us, call me. I'll go over it with you. I'll tell you what our approach is to these entries and how you should do it. But if you haven't adopted it yet, or you haven't, it has to be adopted. But if you haven't accounted for it in your financials, I would recommend you do it in Q3. This way, it's not one journal entry hit to Q4. You can obviously go and amend you can go and change your previous quarters if you would like to do so, but then you would have to restate them and redistribute them. And I don't know if the impact will be material to a lot of the calculations other than the leverage ratio. But this is certainly something that should be starting to look into. There's lease softwares out there that will help you with this entry that you can look into. I have clients that are choosing to do it manually. The biggest thing that I will say is that there's a lot of information that has to be gathered with this calculation. It's not only office leases. You have to include copier and equipment leases as part of this as well. In the past, if it was a capital lease, it would be on your balance sheet, but so this wouldn't have a significant impact. But if it wasn't considered a capital lease, it was always an operating lease which flowed through the P&L. This has to be factored into this calculation. So if you have a significant amount of branches and a significant amount of copier leases, there is a lot of data that has to be gathered to prepare this calculation. And I would certainly, if you haven't started, at a minimum, start gathering all the data that you need for this. Couple of other key points here. Month-to-month leases. What GAAP will tell you is that you have to estimate how long you will be in these leases for. And if that estimate is greater than 12 months, you will have to account for that and estimate on your balance sheet. If it's month to month and you can't reasonably determine how long you'll have that office, it can be excluded. Renewal options, same thing. If you have a renewal option in your lease, you have to evaluate the likelihood of exercising that option. And if the likelihood is high, you factor that into this calculation as well. Any lease that is 12 months or less is excluded from the calculation altogether. You can continue to record it as you previously done in the past. So those are the key points that I wanted to touch on in talking about leases. It is certainly something that your auditor will look at. And just like I tell my clients, it's not an audit entry. We can't prepare the entry and then audit it. So please, I would recommend looking at it. And if you wanted a completely third-party perspective, if I'm not your auditor or your accounting firm, please, you could reach out to me and I could talk to you. Okay, now moving on to notice of material events. I know a lot of my clients have already got the auto email from HUD stating the net operating loss deficiency, which tells you that HUD is expecting this. It's expecting that this is probably happening and it should be reported. Well, what are the three key material events from an accounting perspective that must be reported? Your net operating loss deficiency, which is any quarterly net loss greater than 20% of the company's net worth on a quarterly basis. Secondly, liquidity. You're obviously deficient in HUD's liquidity requirement, and net worth deficient the requirement if you're deficient there. These have to be reported to HUD in the quarter and within 30 days of quarter end. How to report this event is through the LEAP system. If you log on to LEAP, you look at the toolbar that's there. If you scroll over them, you'll notice material event. You click on that, and it's relatively straightforward on how to submit it through LEAP. We recommend that not only do you submit that you have it, put the calculation, put a letter of explanation and a corrective action plan on what you are doing to fix this and to kind of remediate this. I've always said better late than never. I've had clients that have came to me 45 days after the quarter end, because that's how long it would take to close. And they said, we just found out about this. What do we do? And better late to report it than to not report it at all, or to report it at the audit period at the end of the year, because we've had experience with HUD in this, and HUD has been lenient if you don't report it right at the 30-day mark or previously. But they are aware there is emails being automatically generated by HUD. So they are aware that this is probably a deficiency that's happening in the industry, and they're expecting it to be reported. Certain items to consider: if you do not report it, HUD can enforce findings and penalties. We've seen HUD enforce not only a failure to submit the event, failure to timely submit it on top of not submitting it. And I know the recertifications questions have changed, but also not lying on your recertification used to be another finding. So if you recertified and didn't report this and HUD came back and found this, they would fine you. There would be 3 different findings that they would be evaluating. So it is something that I would certainly be doing if it's happening to you today. And the one thing that was changed in the HUD handbook last year is that the calculation is based upon the net worth of the company. You don't have to adjust to get to the adjusted net worth of the company. It says that in the Chapter 7 HUD audit guide. Again, if you can reference it, or if you have a question, I can certainly share that, but it's based upon your net worth of the previous quarter. So your Q2 net loss over your 3/31 net worth. If that is greater than 20%, you're required to report it to HUD. So I know I'm coming up on time here. If I don't want to go into detail on this, but this is a quick snapshot of the things that have changed last year. And obviously maybe in 2020 and 2021, this may have not been of significant or not have been on your radar as much because net worth may have been healthy. Now in this market, depending on your current company's operations, this could play a bigger role in your net worth calculation. And these are some references that you can pull up, the guides that I put here. And I know I originally had monitoring debt covenants on my original agenda. The only thing I will say on that is to get ahead of them. I'm sure if you've already been in violation as of Q3, or Q2, you already are ahead of the game. But if you're predicting that Q4 may put you into a violation, get ahead of the game, speak to your warehouse lenders, because in a market like this where there probably may be more violations than not, warehouse banks are going to take more time to process the waivers, and certain audit firms may hold up release if you're not getting a waiver or have a modification in the audit opinion. And if they're taking time to get that waiver to you, you could be pressed up against the deadline. So definitely I would recommend getting out ahead of it. So that's all for today. I know it was a lot of information in a small session, but I'll be sharing this with the TMC. And if you have any questions, you can reach out to me, email, calling me. You can call me in my office. I'm here every day, but the best way to reach me is by my direct cell phone there.
Thanks, Paul. A lot of information was shared, yes, and a lot of important information. I got do it now and make sure that you're doing it. So don't wait for the auditor. Do it now. So thank you very much. Just want to give the group one last opportunity. If you've got any questions, please feel free to unmute yourselves and ask those. Okay. Well, once again, thank you so much for your time. Really appreciate you sharing your expertise with us. As a reminder for the folks that are on the call with us today, we will send out a follow-up email tomorrow with the reporting, as well as this document, the deck that Paul was sharing. And Paul, if you will send over that Excel template for calculating the risk-based capital, then I'll include that.
Certainly, I'll share that with you right when we get off this call.
Excellent. Thanks so much. Well, thank you guys for joining us for TMC Connect, and please feel free to come back at any time. And with that, everybody have a great day.
See you later, everybody.
Thanks so much.